Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate filings. Today we're diving into Vertical Data Incorporated's latest quarterly report. And let me tell you, there are some pretty wild swings and interesting numbers to dissect here. Think of this report as a snapshot of how the company was doing at the very end of 2025, specifically up to the 31st of December. It is like a checkup for the business, and we're here to tell you if it is looking healthy or a little under the weather. Let's start with their balance sheet, which is a snapshot of what the company owns, what it owes, and what its owners have in it. At the end of December 2025, Vertical Data Incorporated had about $421,816 in total assets. That's not a giant number, but what is more interesting is how it is changed. Their current assets, the things they can turn into cash pretty quickly, were $420,449. Now look at the previous reporting period, the 30th of September 2025. Their total assets back then were a bit higher, around $519,169. So in just 3 months, their total assets dropped by almost $100,000. That's a noticeable dip. On the other side of the coin, their liabilities, or what they owe, also changed. Their total current liabilities at the end of December 2025 were about $359,264, up from about $252,058 at the end of September. This means they owe more money now than they did a few months ago. This increase in debt, while their assets are decreasing, is definitely something to keep an eye on. And when you combine assets and liabilities, you get equity, which is essentially what the owners have left. For Vertical Data Inc., this is actually a deficit, meaning they owe more than they own. At the end of December 2025, this deficit was $62,552, a significant improvement from the $267,111 deficit at the end of September. So while they owe more, their overall equity picture improved. That's a bit of a mixed signal. Now let's talk about how the company made money, or in this case, how it didn't. This is their statement of operations, and it shows their revenues and expenses. For the 3 months ending the 31st of December 2025, the company only reported $57,000 in revenue. That's a massive drop from the $36,600 they reported in the same period in 2024. That is a 98% decrease in revenue. Imagine losing almost all of your sales in a year. That's a huge change. Their cost of revenue also went down, which makes sense since they sold so much less. It dropped from $3,598,000 to just $48,900. This means their direct costs for selling products significantly decreased because there were hardly any products being sold. The result of this dramatic drop in revenue is a tiny gross margin. They were left with just $8,100. A year prior, their gross margin was $68,000. That's a drastic reduction in their ability to cover their operating expenses with what they make from selling their core products. When we look at their operating expenses, they spent $660,735 in the last 3 months of 2025. This is less than the $905,458 they spent in the same period in 2024, a decrease of about 27%. This drop is mainly due to a significant decrease in stock-based compensation, which is basically the value of stock options given to employees. It went from over $464,000 to about $266,000. Because their revenue basically vanished and their expenses, while reduced, were still substantial, the company ended up with a significant loss from operations. They lost $652,635 during this period. That's a substantial amount for a company with such low revenue, and that loss carries through to their net loss for the 3 months ended the 31st of December 2025. The company reported a net loss of $652,635. A year earlier, that loss was $837,458. So while they lost less money than the previous year, they are still losing a lot of money, especially when you consider how little revenue they brought in. This translates to a net loss per diluted share of $0.05 for the 3 months ended the 31st of December 2025. A year ago, that loss per S-share was $0.02. Even though the total net loss decreased, the loss per S-share actually increased. This is because the number of shares outstanding has changed significantly. Look at the weighted average common shares outstanding. In 2025, it was just over 12 million shares, while in 2024, it was almost 39 million shares. This means the company has significantly reduced the number of its shares outstanding. They likely did this through share buybacks or cancellations, which can make the per S-share numbers look worse, even if the total loss is smaller. Let's look at the statement of shareholders' equity, which tracks the changes in equity. This is where we see some really interesting transactions transactions. At the end of September 2025, the company had over 41 million shares outstanding. But then, in October 2025, something big happened. They cancelled over 31 million shares of common stock from founders and other shareholders for no money. This is a massive reduction in shares, and it's why the weighted average shares outstanding drastically dropped. This cancellation explains why the par value of common stock also decreased from over $4,000 to just $980. By the 31st of December 2025, they had just under 9.8 million shares outstanding. This is a strategic move that can sometimes make earnings per S-share look better, but it doesn't change the fact that the company is losing money. Now, let's check out the cash flow statement. This tells us where the company's cash is coming from and going to. For the 3 months ended the 31st of December 2025, the company used $334,712 in operating activities. This means more cash went out than came in from their day-to-day business operations. That is a big contrast to the $74,248 that came in from operating activities in the same period in 2024. Where did the cash come from then? Well, their financing activities provided $182,000 in 2025, mostly from selling more stock. A year earlier, in 2024, they received a much larger $1,093,400 from financing activities. As a result, their cash on hand at the end of December 2025 was just $220,006. This is a significant drop from the $372,718 they had at the end of September 2025, and a far cry from the $159,537 they had at the end of December 2024. They are burning through cash pretty quickly. The company itself admits in the report that there is substantial doubt about its ability to continue as a going concern. This is a pretty serious statement. It means that based on their current financial situation, they might not be able to stay in business for the next year. They are relying on future fundraising and operating income to fix this problem. Talking about their results of operations, the report mentions that the revenue decrease was due to a reduction in the number of products sold during the period. They blame delays in customer orders and longer lead times from suppliers. This sounds like they are hoping things will pick up, but a 98% drop in revenue is a huge red flag. The decrease in operating expenses is largely driven by a reduction in stock-based compensation, which dropped by about $198,000. While this saves the company money in the short term, it could signal a decrease in employee morale or a change in how they incentivize their workforce. Under the section on other information, there are a few details we should touch on. The management evaluation of disclosure controls and procedures states that they were not effective as of the 31st of December 2025. This means that the systems in place to make sure that all the important information is properly recorded and reported are not working as well as they should be. This is a concern for transparency and accuracy in financial reporting. The company did sell 364,000 shares of common stock for $182,000 in an unregistered offering on the 31st of December 2025. This means they raised some cash by selling stock, but it wasn't through a public offering, which usually involves more scrutiny and reporting. Finally, we see the certifications from the CEO and CFO required by the Sarbanes-Oxley Act. These are statements confirming the accuracy of the report. However, given the not effective disclosure controls and the going concern warning, these certifications come with a significant amount of context. Thinking about Vertical Data Incorporated, it's clear this company is in a very precarious position. The dramatic drop in revenue is the most alarming aspect. While they've managed to reduce some expenses and improve their equity deficit, the core business seems to be struggling immensely. The share cancellation, while boosting per share metrics, doesn't solve the fundamental problem of generating sales and managing cash. The lack of effective disclosure controls added to the going concern warning makes this a high-risk investment. They are essentially betting on a massive turnaround through future fundraising and improved operations, but the current numbers paint a very challenging picture. Alright, that is our breakdown of Vertical Data Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think they can turn things around, or is this a company on its way out? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord community linked in the description below for more discussions and exclusive content. Thanks for watching. See you next time.